Hey, welcome to the Hobart Weekly. This is a series created for our clients to bring you relevant financial planning insights, timely updates, and helpful perspectives each week. My name is Andrew Greer. I'm the Senior Wealth Advisor here at Hobart Wealth. And today I want to talk about one of the most common questions I get from clients, which is, should I pay down my debt or should I be investing my money? And the honest answer is it depends. But I'm going to give you a simple way to think about it so you can make a confident decision. First, this isn't just a math question. This is a math and a behavior and a risk decision. Okay, the numbers matter, but so does how you feel about debt, your discipline, and your tolerance for risk. First, let's start with the interest rate. We got to compare your debt interest rate to what you reasonably expect to earn by investing. If you have high interest debt, think of credit cards in the high teens or maybe even higher. Paying that debt down is usually the right move because paying off a 20% interest rate is essentially a guaranteed 20% return. That's very hard to beat in the market without taking on significant risk. On the flip side, if your debt is at a lower rate, think of many mortgages and some student loans, investing starts to look more attractive over time. Markets have historically provided higher long-term returns, but those returns come with volatility and are not guaranteed. Think about risk versus certainty. Paying down debt gives you a guaranteed outcome. Investing offers a potentially higher outcome, but with uncertainty. So the real question becomes, are you more comfortable locking in a sure thing, or are you okay with some ups and downs in pursuit of higher long-term growth? We also have to look at cash flow. It's a big part of this decision. Debt impacts your monthly flexibility. Paying it down can free up cash flow and reduce financial pressure. Investing, on the other hand, builds long-term assets, but doesn't immediately improve your monthly situation. So ask yourself, do I need more breathing room today, or am I focused on building for the future? Another thing, don't ignore the behavioral side. This is where personal finance becomes personal. For some people, eliminating debt creates momentum. It reduces stress and helps them stay consistent. For others, they're comfortable carrying low interest debt and can consistently invest without issue. Knowing which camp you fall into matters more than most people think. So to summarize, there's no one size fits all here. But a good rule of thumb is, number one, prioritize high interest debt. Be thoughtful with low interest debt and make sure your strategy is something you can stick with, because in the end, consistency, not perfection, is what drives long-term success. If you want help walking through this with your specific situation, feel free to reach out. We're always happy to help. Thank you all again for spending a few minutes with us on the Hobart Weekly. We hope this was helpful, and we look forward to continuing to share insights that support your financial life. See you next week.